This morning, and we did highlight that the stock market's in a relatively positive mood. We haven't seen a lot of that recently. Part of that seems to be optimism on the tariff front. Obviously, as we move into April, there's a lot of concern about that next round of tariffs coming from Washington, but our Bloomberg partners had reported that second round due April 2nd would be more targeted than the sweeping measures that were previously anticipated. And the market seems to be taking a little bit of risk this morning, buying back into some of those beaten up technology stocks. Does it suggest that this correction that we have seen for the stock market was a momentary lapse? Let's get some perspective now from Brian Belski. He is Chief Investment Strategist at BMO Capital Markets. Brian, it's great to see you. I guess let's start with how you're making sense of all the tariff headlines. Obviously, they come all the time these days, and oftentimes the narrative changes by the hour, it seems.
Great to see you, John, and good morning, Canada. Humbled to be on a day like today. You know, our view remains resolute. We continue to believe that the United States stock market is in the midst of a very large secular bull market that started in 2009. And since we came to BMO in 2012, we've been very consistent that as America goes, so goes Canada. And we do believe this too shall pass. We do believe as investors and as strategists, we deal with what we know, not with what we don't know. And I think what's been going on in the market, quite frankly, around the world, but especially North America year to date, quite frankly, John, has been all about dealing with uncertainty and really focusing on fear. And per your question with respect to the correction, we wrote a piece a week ago Friday in the United States, and that we knew then that the U.S. stock market hit correction mode under 10%. We also know that when the market in the U.S. corrects that fast under such a short amount of time period, it typically and historically reacts to the upside and reverses very strongly. And that's exactly what is beginning to happen. This was a correction. It was a normal correction. It is not the start of the bear market, and certainly is not the start of a recession. And oh, by the way, that's very good news for Canada. Canadian investors need to take two steps back and realize, you said the numbers at the top of the show. The Canadian stock market actually is outperforming the U.S. stock market in local dollar terms. And no one's talking about this because we're so focused on the fear and uncertainty of what's going on in the tariff situation.
Well, it's interesting to hear you say that. I mean, as you know, there's this theme of buy Canada. There's growing evidence actually from Bloomberg that Canadians are buying a lot more ETFs in Canada right now. So there is still some confidence in the stock market, I guess. There are so many historical stats that will build the case that the bull market could continue. You sort of cited a few of them there. Oftentimes, the but that we hear from people is, but what about Trump? What about, how far he's willing to take things, how far he's willing to rattle the economy? Is this time different?
Yeah, but with President Trump, it's always dangerous, John. It's always dangerous to say this time is different. And look what happened over the weekend that we're talking about today. And we don't know until we know. We don't know until we know with respect to the tariffs. And April 2nd, obviously, is coming very fast. And from our lens, there's probably going to be a lot of changes between now and April 2nd. That's very clear. Also, you have an election in Canada. There's going to be some changes with respect to how the negotiations are going with respect to not only the United States, but Europe and around the world with respect to your Canadian leadership. So you don't know until you know. So here's how you handle that. You handle that by buying exquisitely great and consistent assets in Canada that have great cash flow, pay dividends, and have very strong products or services. And we said this from the very beginning, when the very first tariff situation came out, we said, listen, there's going to be several companies in Canada that can, will, and should continue to outperform the Canadian stock market. And that's exactly what has occurred. So I think Canadians in general have to kind of check their emotions to the side. I know it's super hard, but we're talking about a longer term picture of the relationship with these countries, our two countries over 175 years, that has been resolute. And we do not believe that is going to change.
Well, and I appreciate you putting forth a view with conviction. It's always helpful in an uncertain market. I do want to talk a little bit about positioning. Before I get there, though, just a reminder to our audience that when you look at performance around the world, I mean, Europe has had very strong performance this year. Arguably, because of policy reactions to the Trump administration, whether it's the need for more military spending, which has helped defense stocks, whether in some cases you've seen more fiscal support. So there are these global ripple effects. You mentioned the Canadian stock market, or the Canadian election, I should say, and the campaign pledges we are likely to see from the Liberals this time around are going to sound very different from the last time the Liberals were on the campaign trail, more business friendly at the very least. So are you considering those dynamics as well when you try to sort of look at the offsetting factors for fear out of Washington prompting certain things that could create a little bit of a softer landing for economies in a worst case scenario?
It's a wonderful question. Thanks for teeing it up, because we've known each other for a long time, John. And you know that I don't really like talking about politics, because we've said for years and years and years, politics has nothing to do with the absolute performance of the stock market. It can either deter or enhance the current trajectory. Right now, it's deterring it with respect to some of these policies, but that's why we really focus on fundamentals. And if you talk about Europe from a fundamental perspective, it has no growth, has no earnings growth. Sales growth is terrible. Cash flow is very, very bad. Debt to equity it still remains at all-time highs, even though valuation is very, very low in Europe, even after this huge run. Why? Because the European stock market has massively underperformed North America for over a decade. And so from a price performance perspective, technically, yeah, of course, it's working. It's doing very well. And we've seen some currency changes in Europe. We're seeing some government changes in Europe. But fundamentally, what is that country actually producing? What are their services? What's their fundamental attributes? Not just in terms of the small part where with defense spending or telecom or some of the pharma stocks in Europe. What do they have longer term relative to the North American markets? You just have to kind of take two steps back. You never buy an asset, John, as you know, just because it's going up. You buy an asset because there's something fundamentally sound to it. And that's why North American markets, in our view, still look the best.
Okay, listen, I always appreciate it because, most of the crowd has said, take a closer look at Europe. You're holding the North American broader flag. I don't know if we have a North American flag held high right now. So we do have to wrap up, but you talk about companies that generate nice cash flow, that kind of stuff. Can you give us a sense whether it's sectors or the kinds of stocks that you'd be leaning into right now?
It's interesting in Canada, and we wrote about this, is that the majority of the auto parts makers in Canada massively started to underperform in November. Much of the pricing priced into this silliness with respect to the tariffs happened in November, December, January. So there might be an opportunity there. We'd also say that in the consumer space, stocks like Aritzia and Dollarama still have done very well, and they were wonderful performers last year when the Canadian consumer was in trouble. Lastly, I will say this in terms of the Canadian banks. The Bank of Canada is clearly going to be cutting interest rates. You've mentioned in the top of the show about housing prices going up, but at the end of the day, Canadian banks are amazing stewards of capital with respect to cash flow yields and how they're throwing off dividends. So our own stock, BMO, they're centered on the U.S., but RBC, TD, we continue to believe those are the three big juggernauts that you should be focusing on.
Okay, Brian, appreciate the time. Good to see you as always, and we'll keep tracking the markets. Brian Belski, Chief Investment Strategist at BMO Capital Markets.